Afternoon, everyone. Thanks to our august panel. My name's Kyle Decker. I'm a partner with ICR. We're a leading global communications and advisory firm, helping companies navigate the media, investors, and markets to shape and control the narrative and optimize valuation. I've got more than 20 years experience in special situations, transactions, SPACs, IPOs, and other sorts of dramatic things. So I think this will be an extension of the last panel. This goes into year one, so we'll get into sort of, scenarios that you all have gone through with companies that are right out of the box from the IPO. We'll think about that, but I think we can also back up into what would you advise on a readiness front and, sort of thinking ahead for management in what does that first year look like and how do they manage through it effectively. We know that the street is going to be monitoring very closely for, 6, 12, 18 months, for that performance. So let me do this. I'd like to pass it to each of our panelists to introduce themselves, provide a little context around your background and what you're offering to today's panel. John, maybe I'll turn it over to you first.
Hello, everyone. My name is John Marchese. I represent Arthur J. Gallagher Insurance Brokerage. I lead their IPO and public offering SPAC traditional IPO practice as it relates to D&O and transactional liability for M&A.
Nice to meet everyone. I'm Patrick Murphy, partner at GTS, an electronic market making firm. I run systematic market making for GTS. I'm the CEO of ClearList, which is our private market platform.
Hi everyone, I'm Mike Weixner, co-founder of Dragon GC. We're pleased to be a sponsor of this event, and what we do is we help emerging companies that want to go public use AI to do compliance, corporate governance, and shareholder communication more efficiently, and also after they become public.
All right, super. Let me jump in. We don't normally have a market maker on a panel, so super awesome that you're here with us today, Pat. For newly listed companies, right out of the gate, what are they looking for? How much are you speaking with management teams? How much do they get it or not? What does that look like?
Good question. We hope the company that picks to go public picks an exchange, either NASDAQ or New York. If they pick New York, they have a choice of a market maker. It's either GTS or Citadel, Virtue. And then from there, we hope they have a very experienced IR team and a CFO that understands trading. Because once they go public, the first 90 days, the syndicate pulls back. There's a lot of flows that can cause some volatility. We did Reddit this year. There was a lot of meme action going on and a lot of explanation of how it trades. What they're really concerned about is the derivatives that get attached to the company as it trades, options, ETF weightings, hedges, eventually FX if it's a multinational. So there's so much things to dissect, and we're free for service. Once we trade, we try to use our internal proprietary trading from each group and try to give some really good insights. And they have a ton of questions. Once they get used to it, after a year or so, they kind of understand, and we kind of give them quarterly reports on how it trades and how their auctions look like. If we see something come out of the ordinary, an option hedge or an ETF hedge, we flag it. We give them that information so they can talk to their holders and give information to them.
Super cool. I'm going to stick with you just for a minute because this is kind of a good thread. What differentiates companies that successfully maintain stable trading and pricing for year one versus those who are super volatile and whatnot?
Reddit was very volatile, but in a good way. It went up. It all depends on the industry that they're coming in and launching, the holders behind, right? If they're sticky, long-term, that kind of stuff. Try to stay away from other than traditional IPOs. Some of the ones that didn't work this year, some tried direct listings, which, not saying it's a thing of the past, but a lot of the companies just do not like pricing, and I think the banks do a really good job on pricing now. It's not the massive focus of the VCs from the past. And I think the traditional IPOs have a really good bank behind them with good liquidity, good credit, right industry, gets the right targeted base, looks at peers that went public before them, and gets a lot of data from that, those sorts of things.
So let me back up and shift gears a little bit, maybe. First year as a public company, lots of new things, also not lots of new risks, right? And maybe I won't put it in the context of like preparing for crises, but that may be what you want to do. The last panel was thinking about this as well. Thinking about being ready for the downside. John, if things don't go well out of the IPO, and say, for example, that first set of earnings, they're not performing, they're not delivering, there is extra down volatility on the stock. What is the pathway to a claim? What do you talk to management teams about being prepared for with respect to sort of a bad trading year, lawsuits, shareholder activism, that sort of thing?
Really good question. So let me take it back to the very beginning. So in the year prior, even 2 years prior, if you're taking a really simplistic view, I mean, it's a real laid out and formal framework of, say, GRC, right? So governance, risk management, and compliance. And not only compliance with laws, but compliance with your internal governance and risk management, how effective you are with implementing these strategies. So when you take a company pre-IPO and you're working with them and you step into the company, there's an inherent level of risk with any opportunity or activity, I should say, in an entity. And when you implement the GRC, you get out the other side. Hopefully you have a lesser inherent risk associated with the business that becomes cheaper to finance or transfer off. So when you get into year two, so now you put the program in place, you're thinking about everything that's commensurate with being a public operating company and how well they're doing these things. The earlier panel spoke about how well they're doing on calls, if they're hitting their targets, what their projections look like, everything there that could potentially lead to not only shareholder loss, but potentially shareholder disruption. When you're assessing that and even management changes, then you get into this second year, or I should say this first year of an operating company's second year of the program, and you're assessing that to be dynamic with the program. Limit purchasing thesis is critical, right? So this is something that's should be dynamic. Historically, it's set and forget. I have companies that purchase 300 million in limit. I have companies that purchase 20. The boards are typically very emotional in their purchasing because you're talking about personal assets. It's objectifying, again, those pathways to claim, right? So again, now back, it matters on which pathway you've taken to the public market, because there's a drastic difference in traditional IPO versus SPAC. Matters where the cash goes, whether it goes to growth, whatever it is. So when you assess that, that's when you're actually getting into, okay, the discussion is what could lead to the pathway claim, and then to the earlier panel when they spoke about short-sighted activism. In a traditional IPO, short-sighted activism, as it relates to risk and insurance, traditionally the allegations that are made fall short of an allegation of a direct breach of securities laws. In SPACs, it's the opposite. You get direct allegations of breaches of securities laws. So the first one falls short of triggering a policy as it relates to insurance. Maybe you stand up a committee to investigate, but the second, on the SPAC side, you're actually triggering the policy, so you're getting into things like that. So it just depends on which pathway, what their appetite is for risk, and then how you address it.
Right. Interesting. Mike, let me turn it over to you. I'd love you to sort of tell a bit of the story about how you engage on, you can talk about the claims perspective, the risk side that John just touched on, but also there's a whole bunch of new things that companies are handling and addressing that first year.
Yeah, I really appreciate his response, because a lot of what the problems and the crises that occur are from a lack of preparation beforehand. So, that's one of when I think about the crises, which I think people are very concerned with, you have both the risk that happens and the exposure. And I think one of the main things is a lot of the preparation is not just about reducing the chances, but like how bad will it be if it happens. So if you don't get your risk factors right, or there's something wrong in your disclosures when you go public, the you can be responsible for that. It's like a really bad thing, and then that can be triggered in the future if your price goes down, regardless of whether the thing that you disclosed was related to the reason that your company had trouble. So, but there's all these things that you have to do in your first year that you never had to do before. You know, the care and feeding of investors, financial reporting, your K's and Q's and earnings. Or tip and trick is negotiate with your counsel in advance for those things you're going to have. You've got an annual general meeting, and you can have these own goals. Zoom did a virtual meeting and they blew it in their first time, which is really ironic. And there's all these compliance things. In insider trading, Boston Scientific, Colton Financial, they got they misreported that. That's on the directors and on you. It's, really terrible things. Reg FD, Therapeutics MD didn't release the information about the drug approval, got in trouble. But even big companies, like with cyber attack, that could happen to anyone. Microsoft had a big one, but if you track it all the way through, it was really terrible because, to add insult to injury, they got a shareholder lawsuit because they said they didn't disclose the risk properly, beforehand. So they've gone and they fixed that. But that, now that with that example, that's the kind of thing that a company can get in front of to reduce the exposure in case they have a cyber attack. So there's a lot of things that you have to do, as a public company after the bell has rung.
When would you suggest to a management team to get involved, to work with you? How do you work with teams? Are you part of sort of the outside counsel team? Do you work with other outside counsel teams? Do you work with internal communications teams? Sort of curious about that model.
Yeah, our principal buyer is the in-house team, but we also work with everyone in the ecosystem that is involved with disclosures. The ability to do the research and to look at precedent and all of that touches accounting, obviously the outside law firms. So, that's where our goal is help anyone that's, advisory firms, anyone that's helping companies with these issues.
Right.
I should say, when a company goes public, the first thing they ask them, what was your biggest friction point? They say D&O insurance.
Right.
I think it's triple or quadruple. I know that's like 5 or 6 years. You would know better than I say, oh, what was your biggest pain? Oh, at the last second I had to get this D&O insurance. And they're like, it's crazy. I don't speak with a lot of happy people.
But to another point earlier made on the earlier panel was about the first day pop phenomenon. If you look, there's real thesis behind, and there's white papers written on pricing liability into the trade, right? So the banks are looking at that, they're pricing liability into it, lesser market cap at risk. That's a real thing.
Right. Let me shift into sort of a scenario, and Pat, if you don't mind, can you tell us about the Reddit situation, and how much was the management team, engaging with you, and what were you seeing, and how crazy was that from your perspective?
Yeah, they picked us because we did Snap and Pinterest, and they wanted to be in the same sector, and we did a really good job at that. So they picked the same bank. So we had a different makeup on the IPO on the allocation. They wanted to be friends with their loyal customer base, and they allocated a big portion of the allocation to retail, which got the guy, Drew, the CFO, very nervous based on the volatility of it. Usually a company comes in, they ring the bell, a lot of hoopla, takes a couple hours to open it, then they go upstairs and they celebrate. Drew sat with us the whole day to the close. The characteristics of the stock, it traded 100% the flow the first day. Usually we do about 75%, so that was pretty cool. They're really involved. So after the execution on the opening, we're able to tell and dissect like what was retail, what was institution on the execution. So if a chunky investor wanted to get out or got out on the opening auction on the open price and flipped it, we can indicate that to them. We can get the retail component of how much was on the print and some of the trading activity in it. They really care. They're really involved. Ask a ton of questions. Reddit wasn't great example because it just had that meme activity, and it caused a lot of meme activity in other stocks when it was private. So it just went crazy in the last few weeks if you look at the chart. And it just seems to always have that factor, and people are making a lot of money on meme activity. Traders do. So it was a really cool IPO, and they weren't expected as went up, and it was really good. That's not always the case. So we did another one that was really interesting, DXYZ, which was Destiny 100, and it was the founder of Forge, and he put together a closed-end fund of private securities like SpaceX and top-tier names. Had an NAV at 6. Was a direct listing, sort of. He didn't use a bank, he used our balance sheet, and it went from $6 to 100. And it was tough to make a market on, and it just had some meme activity the last couple of weeks also. And you know, these things can be really tricky, right? It all goes by flow, and people see some activity to make some money, really move it. Reddit had a pretty good investor base, so not only did it have the meme activity, but it had some pretty solid, people. And they had a valuation in mind where if it got unreasonable, they would do some action. So.
John and Mike, do you have thoughts around kind of the meme situation, really heavy retail situations in terms of the way you work with management teams, or any advice that you provide in that regard?
I don't think we have a particular experience with that. We're helping people, disclose their real businesses. I don't know how that affects meme or not meme.
I would say it's important to keep in mind that liability attaches to negligence, right? So it's not always going to correlate. Volatility doesn't always correlate to liability for the team. Even in the instance of a declining business, the way that you're informing the investing public is everything. I've had $2 billion destructions in shareholder value inside of 18 months without a claim, and then I've had, losses that you would think were de minimis in market cap that got covered up in FCAs and follow-on derivatives. So it's just how well you're informing the public. To the earlier panel again, you're timely filing, you're speaking with analysts, you're doing things to inform the public and give a real accurate pathway of which you're making forward. And then if that fails, you do have protection of the business judgment. So it's critical to remember that it's not always over.
So thinking about sort of dramatic events in markets, a short attack. Let's maybe think about that in dynamic of volatile stock and whatnot. John, just to continue, if you don't mind, that seems like a natural pathway to a claim. What's covered under policies, like in defense? Sort of how do companies handle that? What would you say to them?
Right. So again, to my earlier mention, it depends upon whether or not how the allegations are structured and whether or not they trigger the policy. If there's a direct allegation of breach of federal securities laws, then the policy is triggered under the definition of wrongful act, which is an error, omission, misstatement, misleading statement, breach of fiduciary duty, breach of federal securities laws. So now you trigger the policy, and now you're starting the clock on defense. You have to remember that defense and settlement comes from one bucket of insurance, which is why it's so critical to ascertain your limits. And that's a big part of my job is, I'll be one to be critical of the industry's limit analysis. I think the regression analysis and probabilistic modeling is flawed. For all intents and purposes, I've been around Wall Street, public companies for 25, going on 30 years. I've yet to meet a CEO or a CFO that's told me or been willing to tell me how similar his business is to his competitor, but yet they're very concerned about what their competitor is purchasing as far as limit for D&O. So it's very counterintuitive, but that's really the key, because there's a well laid out chronology of a short-sighted activist attack. You can trigger the policy in other ways if it's structured correctly to stand up IR, PR response, which is critical.
Yep.
So that's one of the things. And then again, that varies because you're looking at the cash condition of the company to determine all of these things in the design of the program. And so again, it differs on the pathway that you got.
Yeah. Mike, Dragon's GC probably more focused on, what the company was doing from a governance standpoint. But, what would you say to them with respect to staying ahead on the curve on issues, governance gaps? How would you work with management teams to be prepared for such an event?
Yeah, I think that the key thing is that we're called Dragon GC because dragons are these unknown things, and you're responsible for everything, and it's an ever-changing landscape, and so you want to be tracking these things, but also looking talking with the competitors, like where's the herd going? Can I just walk, especially for some of these issues that are core to your business, like how can I do this in a reasonable way? It's not going to get me in trouble. It's not going to be too costly. And that's really just looking at what other people in the marketplace are doing. A lot of work with cybersecurity policies. It's a good example of that. I mean, there you also have like real risk that you're dealing with. So but that's not your core business. So that's how we help people.
Right. And then a short attack might certainly possibly create a truck trading halt. Right, there may be more color that management teams, defense wants to get on what's going on in the marketplace. How would you handle that? What do you see, or what do you discuss?
It's one of the number one questions we get from the company. Who's short our stock and how much, right? And it's very difficult to find that out.
Yeah.
Really, we look at our internal trading and everything, how we touch the stock. We trade at GTS 6% of the market. In an individual issue, we trade probably about 20% of the total trade volume. So it can look like how our counterparty activity against us, and we can dissect and do as much work as possible, but it is really, really tough. Market makers and some other order types are just marked short for safety. So it really is tough until it gets published correctly, and then the short interest picked up by the third-party vendors. But you can tell when something's under attack. So we can tell from normal trading activity that the sell side 2-1 or heavy and stuff like that is usually short. Gets into short restrictions, which is never good for a stock. Halts. I personally hate halts in the market. I think it creates a little bit of panic for investors. Why is the stock halt? Maybe sell. I think that continue to trade in this electronification of the markets is the best way, right? There's plenty of liquidity in the market. Everything is AI-based, algorithmic. It doesn't stop. It amazes me sometimes on these manual situations that we get on auctions that people are sitting there trying to make a decision in minutes when everything is picked up by technology in microseconds, nanoseconds. So I hate vaults. But it is one of the trickier questions we get, and it's probably one of the hardest answers for us to deliver, like how much of it short until it actually is published.
So, only a couple minutes left, so maybe just a different flavor to see what each of you have to say about regular way IPO and sort of first year out versus a SPAC, right? SPAC IPO, they're structured differently, right? They sort of play out a bit differently, liquidity different, sort of governance may be different. Maybe Mike, I'll start with you just for any thoughts there.
Yeah, so we haven't yet worked with SPACs, but really talking at this conference, what I realized is that there's a particular challenge, which is that you have a private company that's going public really quickly and it may not be ready. I heard of one story where they had to restate their financials and then they went bankrupt because of that. So I think anything that could do to go faster and more efficiently and make sure we don't have an own goal like that would be highly desirable.
Yeah, I'm just in favor of the traditional IPO, where you hire a bank, they do their job, they price it correctly, they sell it correctly. We got SPACified a few years ago through COVID, and it just seemed like it was crazy product. And then the traditional IPO, the banks do a great job, and you don't hear the rhetoric of pricing anymore. And then for a company, it's price, right? So how expensive is this SPAC? The deal that they're going in, the management fees, charges, all the little things that come with that. They would put it down on the spreadsheets and say the pros and cons. And, you know, a regular IPO for a multi-billion-dollar company could cost more than 20 million, right? 20 to 30 million. But you're getting sold correctly. You're getting to the right in front of the right investors. You're getting the relationship with the bank going forward with credit and all the ways they can help you in trading capital market products and all that good stuff. Yes, liquidity.
From my side, it's a really extensive conversation in comparison. But I'd say on the SPAC side, it's proven, you know, private equity-backed assets are more mature. They perform demonstrably better in the aftermarket. Really, it's the opportunity cost play on how much capital is going to the balance sheet, where the event-driven strategies from upfront are being recirculated to the cash at the close. That's critical for indemnification, for operating. So the plaintiff's bar will take the actual proxy and they will quote directly from it, bullet by bullet. You said that you were going to hire highly skilled software engineers to scale. You said that you were going to do strategic M&A. And at the end of the first year, if you haven't done those things, they're going to point fingers at you. So traditional IPOs are much easier in that fact. You know, the cash is there most times, or should be. So it's just it's a completely different risk profile, and you're purchasing pieces in front of it.
John, how we doing? Oh, we're out of time. Good. Thank you all. Thank you.